Good afternoon, students. We will start the chapter 19, Working Capital Management. The outline will be the section 1 will talk about overview of working capital. Second section will talk about trade credit. Next will be receivables management. We'll see payables management in 19.4, inventory management 19.5, and cash management in 19.6. Let us start. What do we mean by working capital? Working capital is the capital which is needed for the day-to-day operations of the business. It is further classified into gross working capital and net working capital. Gross working capital is the total of the current assets and it is not of much use. In practice, most of the organizations they use the net working capital. Net working capital is the difference between current asset and current liability. Therefore, because net working capital is really used in practice, therefore we will see the components of net working capital. Because current asset minus current liability, so we will see the components of current assets and current liability here. Current assets consist of cash, inventory, receivables. Examples of current assets we can take cash, inventory, and receivables. And for payables, we will take as example of current liabilities. So once we make the current liability deduct from the current asset, we get the net working capital we have seen in many other chapters. Now we have the conversion cycle. Conversion cycle means where from you started the operation, again how much time you are reaching at the same point. That is the cycle. So cycle can be of two types. One is the operating cycle, the other one is the cash cycle. So operating conversion cycle, cash conversion cycle. We call it as OCC or CCC. What is operating conversion cycle? It is the total of the time starts from purchase, ends with getting back money from the supply from the customers. So it starts with buying of raw material, ends with getting money from the customers after selling. So this is the operating cycle. So what is the formula? The formula will be total of the inventory days plus receivable days will be the operating conversion cycle or operating cycle. It is not of much use. Much use is the cash conversion cycle. Actual cash we are interested. How we can find? This is the cash you paid and cash you get back. We measure in terms of cash. What is the formula for this? The inventory days plus receivable days minus payable days. How we calculate the receivable days, inventory days, and payable days? We have seen in the financial statement analysis under the efficiency, asset efficiency measurement. We have seen all the inventory turnover ratio, then inventory days, receivable turnover ratio, receivable days, payable turnover ratio, payable days, then receivable turnover ratio, receivable days plus inventory days minus payable days, cash conversion cycle we have seen in the financial statement analysis. Now let us see again, let us remember what we have learned there. Quickly let us focus on the formulas. Cash conversion cycle is equal to inventory days plus receivable days minus payable days. Inventory days is to be calculated using the formula inventory divided by average daily cost of goods sold, and receivable days is equal to receivables divided by average daily sales. Payable days is equal to payables divided by average daily cost of goods sold. So these are the three formulas we have used in the chapter 2 financial statement analysis. Here we just took those three ratios required for cash conversion cycle. So cash conversion cycle is the time money went from your pocket and the time money comes into your pocket. So the time taken is known as cash conversion cycle. This will be how many days cash is tied up in the inventory, that is inventory days. How many days cash is tied up in the receivable days, minus how many days you have not paid to your payables, minus payable days will give you the cash conversion cycle. So here is the example. The first, the green line is talking about the operating conversion cycle or operating cycle, and the orange line is talking about cash conversion cycle. So the green line talking about inventory days plus receivable days, but not much of use because payable days is not deducted. Actual cash conversion cycle or CCC is equal to receivable days plus inventory days minus payable days. We have seen the formulas in the previous slide. The inventory days is equal to inventory divided by daily cost of goods sold. The receivable days is equal to receivables divided by daily sales or sales per day, and payable days is equal to the payables divided by cost of goods sold per day. So this is the formula we will use and calculate the conversion cycle for Apple incorporation here. The sales of Apple in 2015 is 233,715 millions. Cost of goods sold is 140,089 millions. Receivable 16,849 millions. Inventory 2349 millions. Payable 35,490 millions. Dear students, you have the receivable, you have the inventory and payable. Now what do you want? Numerator is there. For receivable days, numerator is receivable, you have. For inventory days, the numerator is inventory, you have. For payable days, numerator is payables, you have. Now the denominator we have to calculate. We need sales per day, cost of goods per day. So sales per day is equal to 233,715 million per year divided by 365 will be per day sales. 140,089 is the yearly cost of goods sold, annual cost of goods sold, divided by 365 will be per day cost of goods sold. Get it? Put the formula and get the answer. Per day sales is equal to average daily sales is equal to 640 million per day. Average cost of goods sold is equal to per day cost of goods sold is equal to 383 million. Now inventory days is equal to inventory 2349 given in the question divided by average daily cost of goods sold, we calculated about 383.81 million, is equal to 6.12 days is inventory days for Apple. Receivable days is equal to receivable, that is 16,849 million divided by sales per day. We calculated above 383.8 640.32 is equal to receivables 26.31 days. So your money is tied up in inventory. Apple's money tied up in inventory for 6.12 days. Apple's money tied up in receivables 26.3 days. Now payables day. Payables divided by daily cost of goods sold. Payables given in the question 35,490 million divided by daily cost of goods sold calculated above 383.81 is equal to 92.47 is the payables day. Now put the formula for cash conversion cycle. Receivable days plus inventory days minus payable days. So 6.12 is the inventory days plus 26.31 is the receivable days minus 92.47 is the payables days. So the cash conversion cycle is minus 60 days. See how good the company is managing. The company is first getting the money 60 days in advance. Then it manufactures after 60 days. So that kind of efficient management the company is doing. So certain implications of this is it has a negative cash conversion cycle. That means it receives the cash from the customers before it makes the production. Next is the suppliers are waiting 92 days to get paid from Apple. Apple has image so good, goodwill is so strong. The suppliers are ready to wait 92.47 days to get paid because they know this company is a solid company. There is no threat of insolvency. They are ready to supply this company at any cost. And company is taking advantage of this. It is paying the money to the suppliers after 92.47 days. Therefore, on an average 60 days before it gets paid, then it makes the production. That is the way we imply the working capital management through cash conversion cycle. This is a homework for you. You can try for Elite PC 2017. Sales given, COGS given, receivable, inventory and payables are given. That means numerators are given. You have to calculate the denominator, per day sales, per day cost of goods sold, then calculate the receivable days, inventory days, payable days. Cash conversion cycle is equal to receivable days plus inventory days minus payable days. If you face any difficulty, let me know. And the author has taken the source capitalic.com to give the kind of cash conversion cycle of various US company in the year 2015. You can see Molson Coors Brewing Company is having a negative cash conversion cycle of 99 days. Pepsi is having negative conversion cycle of 84 days. Verizon is having 72 days minus. Apple is having 60 days minus. Bristol Myers 25 days minus. Like that, you can come down. Tiffany and Company, it is having cash conversion cycle of 497 days plus. That means once company is spending money, it is getting back after 497 days. Around 500 days it has to wait to get back the money. Similarly, Lenner has 443 days. So too long cash conversion cycle means it is a kind of a lot of risk involved, and you have to wait too long for getting paid the same money you have invested. So this is the way we make the interpretation. Now we will see the value of working capital management from the when we do the capital budgeting project, we get the net income, then we make three adjustments. We add back the depreciation, we deduct the capital expenditure, and we deduct the increase in net working capital to get the free cash flow. Isn't it? So here for a company, Emerald City Paints, the free cash flow is given as 19,000. Right? Now all these amounts are in thousands. So that means net income is 20 million, depreciation is added with 5 million, capital expenditure deducted 5 million, increase in net working capital 1 million. So total free cash flow is 19 million. You can see one peculiar thing here for this company, Emerald City Paints. Whatever depreciation is charged here, added back, that much of capital expenditure deducted here. 5,000 neutralized. Then only working capital is the amount which is further deducted. So your net income became reduced by 1 million and it became 19 million. Now question is, say for example, the net income and the working capital all grow by 4% a year. Cost of capital is 12%. Now Emerald is thinking to reduce its working capital by 20% from the beginning. Then how it will impact the value of the company? We have seen in the very beginning, we have seen that if working capital reduced, value of the business increased. We have seen one of the slide in the beginning, we have seen that working capital, if you a reduction in the working capital requirements generates positive free cash flow that the firm can distribute immediately to shareholders. Farm value and working capital. Slide number 5, if you see, any reduction in working capital requirement generates positive free cash flow. This is the theory. Now let us see this in practical, it happens, or only in theory we read it. Here this is the example given. For Emerald City Paints, the data is provided to you because the depreciation and capital expenditure are the same. So working capital is the only difference here. Company has decided to reduce the working capital expenditure by 20%. How this one working capital reduced means value should increase, free cash flow should increase. It happens or it doesn't happen, we can see in this exercise. Before going to this, we can do this through the spreadsheet. You can, this is example 19.2. Yeah, that's why I was taking time for doing all these representations. You see, cost of capital is equal to 12% given in the question. All clear? Growth is 4% given in the question. Now, the net income of the company is 20 million in both the scenarios. Scenario 1 is the original working capital. Original working capital. Scenario 2, reduced working capital. So, question here is original working capital and reduced working capital. So, question here is the net income is 20 million, no impact. We are not changing anything in the net income, nor we are changing anything in the depreciation, nor in the capital expenditure. What we are doing, only simply, previously the working capital was 1 million. Now we are reducing the working capital by 20%. As per the questions given requirement, we are reducing the working capital by 20%. So if we are reducing the working capital by 20%, then the new working capital will be original working capital multiplied by 80%. So it is 800,000. Using the FCF formula, the FCF will be equal to net income added with depreciation deducted with capital expenditure. So original working capital scenario, the FCF will be 19 million, and in the revised working capital or reduced working capital scenario, the FCF will be 19.2 million. All agree? This is only the sum total of the net income plus depreciation minus capital expenditure minus net working capital. Now our free cash flow increased by 0.2 million. So the theory we have learned, any reduction in working capital is increase in the free cash flow. That is proof number 1. So it is proved here. It is proved here that because of 20% reduction in the working capital, the cash flow has been increased by 20%. You see, 19 million increased by 19.2 million. That means the same amount increased in the free cash flow. Now question is, what about the impact on the value? Once the working capital was 1 million, the value of the company will be free cash flow divided by WACC minus growth. That is equal to 2375. So this will be the value of the company. 237.5 million will be the value in the original condition. If you reduce the working capital by 20%, you see the impact on the value of the company. The value of the company will be 240 million. That means the increase in the value is 2.5 million. Because of simply reducing the working capital by 200,000, you are increasing the value of the company overall 2.5 million. Therefore, any dollar decrease in working capital is increase in the free cash flow, in return increase in the value of the company. That is what being proved here. Now we will go to the second section, that is trade credit. Trade credit is the difference between receivables and payables, that is the net amount of firm's capital consumed as a result of credit transaction. You see, dear students, every business house gets some credit from its suppliers in the name of accounts payable. Every business gets some credit. Every business gets some credit from its suppliers in the name of trade credit or accounts credit, accounts receivable. Same similar pattern, it also allows credit to its customer. It gets credit from the suppliers, it allows credit to the customers in the name of accounts receivable. Again, I am telling, every business gets some credit from its suppliers known as accounts payable. Same, it allows credit to its customers, which is known as accounts receivable. The difference between the receivables and payables is the net amount of firm's capital consumed as a result of those credit transactions. We have seen in Apple's case situation, it is giving credit to the customer around 20 days. It is getting credit from its supplier around 90 days. That means 70 days it is getting extra credit. That is, the difference is either you give extra credit or you get extra credit. If you are getting extra, if you are getting more days credit and allowing less days credit, then you are getting more credit. If you are allowing more credit, getting less credit, then your uh, working capital is positive. Your money is consumed in the shape of credit transaction or as a shape of accounts receivable. So every business has to compare time to time the accounts receivable and accounts payable so that it can know how it is getting credit from its suppliers, how it is giving credit to its customers. Based on that, it can change its policy. So I will just stop the recording here.